Welcome to this new edition of ARGOPULSE, February 2024.
In January, the global market maintained its positive momentum, and the macroeconomic figures published last month supported this scenario of a soft landing. Additionally, the earnings seasons reported good results for companies, reassuring investors that the impact of rates on companies' margins would be limited. The main central bankers decided to maintain the rates at their current level. They adopted a more hawkish approach in their discourse, stating that the economy's resilience allowed them to take their time concerning the tightening of the monetary policy. They do not plan to cut rates during the first quarter, and central bankers want to be sure that inflation moves in the right direction before considering any rate cut. As a result, investors anticipate that there will be no rate cut in March, leading to an upward shift in the long-end yield curve. Investors will be closely monitoring the macroeconomic figures to determine which direction inflation is headed and try to anticipate when the first rate cut will take place. Equities still provide investment opportunities. However, caution is necessary due to potential sectorial rotations caused by the changing macroeconomic environment. Additionally, there may be a shift from big caps to mid caps due to the latter's better performance potential. We anticipate a slight downward trend in gold prices as the market will reprice the first rate cut. The long-end yield curve may shift upwards, which will negatively impact the bond market. Furthermore, we expect some volatility in oil prices. Structured products remain a good candidate to provide opportunities to navigate through these scenarios. Considering the current macroeconomic conditions, we have identified several risks. For example, a sudden downturn in the economy may affect the sentiment investors have towards a soft landing scenario. This could lead to a repricing of all asset classes, since the current valuations are not in line with such a scenario. The recent surge in artificial intelligence has caused a distortion in the valuations of tech stocks, which may result in a correction in the tech sector. We will continue to watch the corporate earnings season with caution. If we see weaker than expected results, it could have a negative impact on the stock market sentiment, leading to a retracement in the current positive trend. We also need to keep an eye on the upcoming presidential elections in the US and other countries, which could impact the market. Political decisions or speeches may also affect market prices. In an environment of high equity valuations and uncertain rate levels, it's important to be selective about investing in the capital markets. Therefore, this month's recommendations focus on two main themes. Following a significant decrease in energy prices by the end of 2023, we anticipate a rebound in oil prices, resulting in increased earnings for major energy companies. This presents an exciting opportunity to enter the market and benefit from the expected upswing. Additionally, the energy sector is undergoing a transformational shift towards decarbonization, with companies shifting from fossil fuels to renewable energy. Many oil companies have already started implementing these changes in their operations. This shift will position these companies as leaders in the energy transition. Consumer staples companies have been highly exposed to the increase in inflation due to their business model of low margins and high volumes. The rise in input prices could not be passed on entirely to the consumers, resulting in a significant shrinkage of their margins. Consequently, companies in this sector have experienced a devaluation. However, things may change for the better in 2024. With decelerating inflation, an increase in purchasing power, and stronger than expected growth, we anticipate the sector recovering part of its losses. However, it's crucial to be selective in stock picking, as some companies may still face challenges and there will be losers. Despite the fall in inflation, some companies did not lower their prices, and some retailers decided to remove some brands from their product portfolio, as seen in the case of Carrefour and PepsiCo. Therefore, not all companies in the sector are expected to benefit from the improvement in macroeconomic conditions. These insights provide us with a compass for navigating the current complex financial waters. Thank you for joining us today. Until next time, stay informed and stay curious.
Contact your Lincius Partners representative to explore further how to take advantage of the current market conditions.